Welcome back to the channel, guys. I'm your host, Buckning, and today we're going to talk about timing versus not timing the market and just staying invested because in these current market conditions, we are seeing massive volatility. You are seeing the end of what could have been a 2023 rally ended during the week there, or it might just be a little blip in the whole progression. So we're going to talk about what it's like to stay invested and what could happen if you try to time the market. And what I mean by timing the market is buying low, selling high, but of course missing possibly the best trading days during that year. And so if you're new to the channel, welcome. This is where you put $100 a week into a tax-free savings account to build a dividend portfolio right in front of your eyes. And if you're not new, welcome back. And so timing the market has always been that argument with people that do not time the market and just consistently invest their funds into the market as soon as they possibly can, as much as they possibly can, and just leave it there. They don't try to sell at a high point, buy at a low point. They just continue to invest, whether the stock price or the market is up, whether the market is down, they continue to buy at regular intervals. Whereas timing, there are investors or funds that will try to time the market the best that they possibly can by buying at the very lowest point and selling at the very highest point and continue to do that. Now, that argument or that thesis has always been there, and to this day, people still put those things together and put them head to head in those theories. But I think the data typically points towards investing consistently, dollar cost averaging in, whether the market is up, whether the market is down. And so you can go and look up this data. I just pulled off a chart, even just off of Google, and it showed the chart of the S&P 500, which is a well-known indices from 1995 to 2022. And the cool thing is that if you stayed invested from 1995 to 2022, the compounded interest year over year, the rate of return would be 7.7%. If you stayed invested from 1995 to 2022, every single year, the average would be about 7.7%. Now, let's say you missed 5 of the best trading days. And what I mean by that is the biggest rallies through that time period, your rate of return would have dropped from 7.7 to 5.9%. That's almost a full, what is that, 2%? Yeah, almost a 2% drop from 7.7 to 5.9. Now, those are only 5 days out of that whole 6,600 some days from 1995 to 2022. You missed 5 of those best days. Your earnings, your rate of return would have dropped from, again, 7.7 to 5.9%. It doesn't seem like much, but do the math on a value of a portfolio. Do the dollar figure to help you, make that tangible for yourself, because different values of money mean different things to different people, right? And so that's just 5 of the best trading days. Now let's talk about 10. If you missed 10 of the best trading days from 1995 to 2022, that rate of return, instead of being 7.7 being invested that whole time period, would have dropped to 4.7% annually. That's missing 10 days, okay? So 10 days does matter when it comes to investing, and there's really no evidence to support that timing the market is better than just staying invested, okay? Now let's say you miss 20 of the best trading days. So we're just doubling it up again from 5 to 10, now to 20. From 7.7%, your rate of return per year from 1995 to 2022 is 2.7%. In today's market, in today's economy, you can find GIC rates that are returning much more than 2.7%. And that's something to be said. Stay invested. Don't try to time the market. Don't play this. Don't be cute about trading or investing. I don't trade. I invest and I buy and I hold for the long term, for a very long term, maybe even forever. Probably for the forever part, I don't even know if I'll be able to use these funds in retirement. And so just so you know. So now we've talked about 5 days, missing the best 5 days, 10 days, 20 days. Let's just talk about 10 more days. You missed 10 more of the best trading days. From 7.7%, your rate of return per year would have been 1.1%. That is not even something people would even consider investing. If someone told you would get 1% return for investing your money, that doesn't even keep up with inflation. Not even considering today's inflation, but the average inflation rate that Canada shoots for is about 2%. I think around the world they just shoot for 2%. You're not even keeping up with inflation at that point when you miss 30 of the best trading days. So that's 30. Let's talk about 40, because it does get to a point where you start actually just losing money. Even if you invested in 1995 to 2022 and you're trying to time things, if you missed 40 of the best trading days from buying and selling and taking out your positions and holding cash, that rate of return would have been negative 0.4% if you missed 40 of the best trading days out of the 6,600 days that there are from 1995 to 2022. Next, let's just do 50. 1.8% in the negative. You can see the effects that happen when you don't stay invested and you start messing around with your portfolio, especially like the S&P 500. That should just be a fund where you just never touch and just let it grow. Or I'm hearing a lot about target date funds, target retirement date funds, and those are a thing as well. So when investors talk about buying and selling and buying low and selling high, it's a very small percentage that are probably able to do that, and the data is out there to show. You might see the one guy who's able to do it and has had success in doing it, but look at the success rate comparably to the vast majority of people that do try to time the market in certain ways. So it's just best to consistently invest your money at regular intervals. I am biased, I guess, against timing the market and just investing and holding for the long term. And so just something to really think about, because in the next maybe year and a half, and this is just my opinion, the market is going to be very volatile. And the best thing you can do is not be scared, but to continue to do what you're doing and invest at regular intervals, because in the long term, you will get that annual compound year over year. It just takes a little bit of patience and a little bit of fortitude and resilience against whatever's happening in the market. And we know this, and so it's not something new, but it's just a good reminder, and to see that data. And you can go look up the data online. It's all pretty accurate. I mean, finances is something that rarely changes, and the data, there's always data, and of course it can be manipulated in certain ways, but this is data from 1995 to 2022 just based on one indices. And yes, I know there are tons of indices out there and all react different to the market. And so hopefully you guys did enjoy the video. Hopefully you have a great rest of the week. Don't forget to leave a like and subscribe if you found value in this video, and we'll definitely see you guys in the next one. Bye.